Hey guys, monthly update in November from us, I guess, on interest rates and house prices. Starting with interest rates, it's a very benign market at the moment. We're clearly at the top of an interest rate cycle with no expectation that the OCR will increase again. We've seen some slight movement up in those short-term rates in the last week or two, mostly with banks catching up with the other banks, and that one-year fixed rate now settled at around 7.35. Although we are negotiating it and we are getting rates as low as 6.99, so it's definitely worth talking to your mortgage advisor when you're looking at rates. As far as the outlook's concerned, we still expect rates to start falling by the middle of next year. And the reason for that, which we've signalled for a long time, is that our view is that, or certainly my view, is that the economy is slowing faster than expected. And that's not surprising to us, because with these really high interest rates and the impact on borrowers and affordability, and as all of you guys will know, your discretionary income is having a pretty big impact. You know, we're seeing weak retail sales. Retail sales have been consistently reported down now for about 3 or 4 months, both in dollar terms and in unit sales, right? So that's a weak economy, especially with the context of the amount of immigration that we've had. But then if we flip to immigration, look, this isn't the silver bullet to pick this economy up. It's low quality immigration. A lot of it's backfill for low skilled jobs where we had temporary Kiwis leaving pre-COVID. So don't expect a miracle there. I don't expect that to flow through into the housing market in a meaningful way. It's certainly not going to drive inflation, and it's not driving inflation. It is driving up rental properties, and we are seeing a bit of a squeeze in that rental market. That's going to be attractive to property investors, along with a reintroduction of tax deductibility. But the challenge for property investors is, we're still in a high rate environment. We're still testing servicing at rates around 9%, and they've experienced increasing costs in terms of rates and insurance, which have gone up a lot lately. So I don't expect to see property investors back in a big way in the current market. They'll be back, but not in a big way. So when we think about what that means for house prices, I think you're going to see a small recovery. It could be anywhere from 5 to 10% over the next year, bearing in mind that house prices were down over 20%, certainly in Auckland and Wellington. And in real terms, if you add inflation into that, they were actually down about 35%. So we'll see a bit of a recovery, but I'm certainly not expecting this market to take off. We're going into a weaker economy, higher unemployment. We've still got relatively high rates out there. We're in this for the next 3 to 4 years. The next housing boom, because they do come around periodically, is at least sort of 4 to 5 years away. What that requires is a strong economy that's got high growth and low interest rates. And when we see that again, and we'll no doubt see that at some point in the future, you'll get another significant surge in that housing market. But with everything that's going on at the moment, you can't see that in the foreseeable future. I don't think house prices are going to fall from here, and there's still people out there that keep talking house prices down. They've come down a long way, particularly in real terms. They really are quite stable now. I'm just not expecting to see them take off again. That's it for us for this month. Cheers.